Many everyday investors mistakenly lump Bitcoin and general cryptocurrency into the exact same speculative bucket. However, the United States government draws a massive, legally binding dividing line between them that completely changes the rules of the game for anyone holding digital assets. The Securities and Exchange Commission, serving as the ultimate regulatory watchdog of Wall Street, treats Bitcoin with a unique level of structural respect that it actively denies to almost every other digital coin circulating in the global market today. To the SEC, Bitcoin is not a tech stock, a corporate bond, or a speculative financial contract. It is officially classified as a commodity, placing it in the exact same legal category as physical gold, crude oil, and agricultural wheat. But what about the thousands of other younger cryptocurrencies flooding the market today? In the cold eyes of federal regulators, highly popular platforms like Ethereum, Solana, and Cardano are treated as fundamentally different economic beasts entirely. The SEC views almost all other crypto tokens as investment contracts, legally defined as securities. This means regulators treat them exactly like unregistered shares of stock in an aggressively speculative, profit-driven technology startup. This critical legal distinction relies entirely on a historic 1946 Supreme Court standard known as the Howey Test. It determines whether an investment involves placing money into a common enterprise with the reasonable expectation of profits generated by others. When you examine most altcoins, they easily fit this definition of a security. They are created by centralized development teams, backed by wealthy venture capital firms, and pushed by promotion departments to enrich their early founders. Bitcoin, however, possesses absolutely none of these centralized corporate characteristics. There is no active chief executive officer, no board of directors, no marketing department, and no central organization pulling the strings of the network. Bitcoin's legendary creator, Satoshi Nakamoto, famously vanished into the shadows shortly after launching the network. This historic act left behind no central entity, foundation, or treasury that could be sued, subpoenaed, or coerced by any government. Because of this extreme, organic decentralization, there is no common enterprise behind Bitcoin. It operates simply as an open-source, global mathematical protocol maintained by thousands of independent computer nodes scattered across the Earth. This clear, centralized managerial control explains why the SEC is aggressively pursuing the wider crypto market, issuing massive multi-million-dollar fines, demanding registrations, and forcing trading platforms to quickly delist unsafe tokens. For projects officially labeled as securities, the burden of regulatory compliance is absolutely staggering. They must regularly disclose financial statements, undergo intense audits, and face severe restrictions that kill their ability to innovate. Bitcoin completely bypasses this regulatory minefield because it has been classified as a neutral global commodity. Established traditional finance can fully adopt and integrate it without fearing sudden, devastating federal clampdowns. This secure legal status is exactly why Wall Street giants like BlackRock and Fidelity launched spot Bitcoin exchange-traded funds first, highly confident that the underlying asset's legal foundation was rock solid and permanently established. By earning the exact same legal designation as physical gold, Bitcoin has successfully cemented its unique role as a neutral, global reserve asset, completely separate from the highly speculative, legally fragile crypto casino. While most crypto ventures behave like tech startups trying to bypass regulations, Bitcoin is uniquely sovereign digital wealth, totally shielded from the concentrated power of any single founder or corporation. When you buy and hold altcoins, you are fundamentally betting on the promises of teams and managers. But when you buy Bitcoin, you are securing a piece of decentralized network history that no government can easily alter or shut down. The difference is clear. Don't confuse the volatile, heavily managed sandbox of general cryptocurrency with the indestructible, legally recognized commodity of Bitcoin. One is a risky tech startup, but the other is the future of money.